All right, welcome back to Starting Your Investment Journey audio series. I am Abiodun Adelu, and my mission is to help people build successful and meaningful lives through better decisions about money, work, wealth, and personal growth. In this episode, we're going to be talking about the financial instruments that we have. Now, up to this point, we've done something very important. We've mapped out where wealth is: human capital, real assets, financial assets, and others. Now, let's go one level deeper. Because inside financial assets, there is a structure that most people interact with every day without understanding what they actually are, and that is financial instruments. What are financial instruments? Financial instruments are specific tools used to create, transfer, and manage financial value. I'll take that again. Financial instruments are specific tools used to create, transfer, and manage financial value. They are not investment by themselves. They are actually structures. Now, let's look at a simple analogy. Think of financial classes as territories. Now, financial instruments are the vehicles that are used inside those territories. Now, you won't just say something like, I am in transportation. You will specify, maybe car, bus, train, or airplane. Now, that is what financial instruments are in investing. So almost everything in financial markets fits into three categories of financial instruments. We have number one, debt instruments. This one, you are lending something. You are lending money today and you'll get it back later with interest. So examples of debt instruments are treasury bills, government bonds, corporate bonds, fixed deposits, etc. I know you've heard those things before, right? So those are debt instruments. So when you buy debts, what you are doing is that you are acting like a lender, not an owner, right? So, and you are not going to get profit. What you are going to get is interest agreed in advance, right? So you know the interest you're going to get ahead. For example, when you put your money in a fixed deposit, what you're buying is a debt instrument. When you buy bond, whether government bond or corporate bond, or you buy treasury bills, what you are buying is a debt instrument. Even treasury certificates and many other ones, certificate of deposit, many other ones. Now, the second category is equity instruments. Under this one, you are not just lending, you are actually part of the ownership. So you are not just lending money, you are buying a share of a business. Examples are shares and stocks. So, for example, now when you own part of Zenith Bank PLC or Dangote PLC, you become a part owner of the institutions. So when you buy equity, you are betting on the long-term growth of a business. What you are saying is that I know that this business will grow in the future and I want to be a part of it. So the returns are not fixed. It depends on the performance of the business. If the business does well, you earn more. If the business doesn't do well, you may earn less or you may even lose your money. The third category of financial instruments are called derivatives. Now, this one is the most misunderstood category. What are derivatives? Derivatives, they have contract whose value is derived from another asset. So derivatives are not assets themselves. They are something linked to an asset. Now, let's look at an example. Let's say that the price of oil changes, right? You don't own oil, but you enter into a contract that depends on oil. That depends on oil price movement. That contract is called a derivative. We'll talk about each of them extensively as we move on. Now, why do we have these financial instruments, right? Or let's even look at derivatives. So why do we have derivatives? Derivatives are not originally designed for speculation. They are designed for risk management, price protection, and hedging uncertainty. So generally, financial instruments are not investment in isolation. They are ways of structuring financial relationships. So you can look at it as from three angles, right? The three financial categories that we have, the three financial instrument categories that we have. So if you are lending, you are buying a debt instrument like a treasury bill or treasury certificates or corporate bond or fixed deposit. You are lending bank, you are lending a company, or you are lending the government. But if you are owning something, then that is an equity instrument, maybe shares or something. But if you are transferring risk, then that is a derivative. So most beginners, they think of I invest in a product, but professionals see it in a separate angle. They see it as I enter into a financial structure with specific rights and risks, right? So once you understand these things, then buying stocks or bonds, it will not be abstract, it will not be mysterious, and it will not be scary again. It becomes something that is logical. It is not a guesswork. So now that we have a broad picture of what they mean, in the subsequent episode, what we're going to do is to now go deeper into each of them, one after the other. We'll look at debt instruments, we'll look at equity instruments, and we'll look at derivatives. Thank you for listening. Remember, learn before you invest. Always build before you buy, rather, and always think long term when you are investing. Thank you for listening, and see you in the next episode.